Hi, welcome back. Hope you're doing well. So far in your sessions, especially the last session, by now you will have a very good understanding of an income statement, the different ratios in an income statement, and how to analyze an income statement and make really important decisions for a company. Now, the income statement is done. That's it. Now, there is another financial statement that goes hand in hand with an income statement. Almost every time there is a change to an income statement, there is also some other change happening in another financial statement. And that statement is the focus of our session today. And that statement is called the balance sheet of accounts. Yeah. To help you understand, give you an intuitive feel of a balance sheet, let's go back to our example, this personal expense example. You remember back in our first session, I believe, we said it's a really good habit to keep your own personal statement of accounts where you write down every month what your salary is and how much you're spending. Now that is what you see here, salary of 1 lakh, and you've been spending all this money, and you finally save some 28,000 rupees there. Now, is that it? So my question is, just this statement, does this give you or somebody else a complete financial picture about yourself? Think about it. Look at the statement. Does this statement give yourself a complete financial situation about you? Is that it? Isn't there anything else in your financial universe that is there other than your revenue and your income? Yeah, not really, right? There are a few other things. Now, for example, okay, your salary is 1 lakh, you've spent all this money, this is the amount of money you've left. Where is that money? That money is probably getting added to your bank balance somewhere, right? You have a bank balance, and some of that bank balance you regularly invest in the stock market, or you buy debt or in a fixed deposit. You have all that happening, right? And also maybe you own a house. Yeah, maybe you own a car, you own a cell phone. Maybe you have a loan and you pay a monthly EMI to, there you go, right? You have an EMI right here. So that means you have a loan, maybe 15-20 lakhs to pay back for your house. You have those things as well. So unless an income statement gives only a snapshot of your financial situation, an income statement, along with all those other things we just said, what all you own, your cash in your bank account, your shares, your stock, and all those things, along with your flat and a car, the amount of money you owe somebody else, only when you see an income statement along with those other assets or liabilities that you own or owe, only then can somebody or you yourself can get the complete financial picture of yourself, right? So this other statement where we're going to put your cash balance and your house and the loan you owe, that is essentially a balance sheet. Now let's look at, if you had to build a basic balance sheet for an individual you, what would that look like? Very simply, you have cash in your bank account. Yes, you have cash in your bank account. I'm just going to make this a little bigger so it's easy to read. You have cash in your bank account. Let's say you've been saving well. You have 10 lakhs of cash in your bank account. Okay. Does the income statement capture this anywhere? Look at this. No, there's no 10 lakhs here, right? So you have cash in your bank account. And then apart from that, you own stocks worth another 10 lakhs. Okay. Does your personal income statement capture this anywhere? No, right? Then you have some money in a fixed deposit. You're a fairly risky guy. You want to put only little money in a fixed deposit and more money in shares. So you have another 5 lakhs in a fixed deposit. Yes. Now again, your income statement does not have any 3 of these things. So you see what a restrictive view of your financial situation your income statement was providing so far. Now let's see what else. We also said maybe you own a flat. Yeah, you own a flat, right? You own a flat. The cost of that flat is maybe, I don't know, let's say 30 lakhs. You own a flat, 30 lakhs, sorry, that's 3 lakhs, 30 lakhs. You maybe own a car, you own some assets, like you own a car, that's another 5 lakhs, yeah. So these are all the things that you own, that you own these things. Otherwise, in corporate finance terms, these are called your assets. These are what you own, these are your assets. Now you also owe money, right? You probably owe, let's say you owe rent, you owe, not rent, you owe your house loan. You took a loan for a house, so you owe a house loan, let's say a 20 lakh house loan you owe. You probably also owe this month's rent, maybe 20,000 rupees of this month's rent. You probably also owe that money. So all these things that you owe other people, that others have a claim on your income, you have to give this money back to somebody else. That is essentially what you owe, or otherwise in corporate finance lingo, it's called liabilities. Is that clear? Yeah, assets and liabilities. So now your total assets, let's calculate what your total assets are. Your total assets are very simple. They're just sum of all your individual assets put together. There you go. You're a rich guy or you're a rich girl. Your total assets are 60 lakhs, but not yet. That's not you don't own that entire money. You also owe people some money. You remember that? So what are your total liabilities? Your total liabilities is 20 lakhs and 20,000. That's your total liabilities. All right. So now, how much are you really worth? What you're really worth is nothing but your total assets, what you own, and subtract from that how much you have to give to other people. That's your total liabilities. So your net worth, or how much you're actually worth, is your total assets minus your total liabilities. There you go. 39 lakhs 80,000 is your net worth. This is your own simple balance sheet for your personal purposes. This balance sheet, along with this monthly income statement, gives a complete holistic view almost of your financial situation. Yeah. Similarly, a company has a simple income statement like this, which we looked at a few sessions back. Just like in your case, this income statement does not give the entire snapshot of a company. This is just one aspect of a company's financial snapshot. A company has its own balance sheet, and I'm going to draw this side by side, so you know there is not a world of difference between like your balance sheet and a company's balance sheet. Is only little. I'm going to say here, I'll just say here, I'm going to say this is your personal balance sheet. Okay, and then we're going to say this, we're going to roughly look at what is a company's balance sheet. All right. Yeah. So hopefully that is intuitive enough to you. Now similarly, just like how you have cash in your account, a company we're just going to make sure this all looks nice and tidy for you to see. Okay, a company also has cash in its bank account. Let's just say the company, it's a big company, so a company probably has more cash than you do. So a company has 50 lakhs in its bank account. A company will not keep all its money in cash in a bank. A company will actually also invest its money into fixed deposits and stocks and things like that. Okay, a company has another 50 lakhs in stocks and another 50 lakhs in fixed deposit. And then we also saw this was called assets. Now when it comes to, since we are getting technical and into this, the kind of assets that are liquid in nature. When I say liquid in nature, is either you have the cash already in the bank account, or you could just sell the stocks or just break your fixed deposit and get your cash immediately. Such assets are called, current assets. Such assets are called current assets. These are the current assets of a company. Okay, and current assets are nothing but assets that are liquid in nature, either cash or cash equivalents like stocks or fixed deposit that can be sold immediately. Now, apart from these assets, a company also has other assets. Let's say they have machinery, like in case of Domino's Pizza, they have ovens and baking trays and all of that. Let's say they have machinery worth 45 lakhs. That's 45 lakhs, yes. Then they have some inventory. What is inventory? We saw in our previous example. Inventory is essentially Domino's or any company has got cheese and olive oil and vegetables and all that in stock in some godown somewhere so that they can be prepared for the next week's demand. That's inventory. That's something the company owns. It's its own asset. Maybe they have inventory worth 10 lakhs. Okay, so you get the sense. And this kind of assets, now these are not liquid assets. If you want cash from these assets immediately, it's going to be very difficult to sell your machinery or your inventory immediately and get cash. It's going to take a longer time. So those kinds of assets are typically called non-current assets. So you see, current assets and non-current assets are the two kinds of assets in a company. Let's just align this straight so okay. Non-current assets, and obviously there are more detailed versions of this, but for the purpose of this session we'll stick to this level of simplicity. So this company's total assets is nothing but the sum of its non-current assets and its current assets. All right, okay. Now, a company also has liabilities, and we saw in Domino's case they have a loan on which they pay interest. So this company has a loan. Maybe let's say the loan is 25 lakh, a 25 lakh loan by this company. Then let's say the company owes taxes to the government. The company pays taxes once a year or twice a year, but it's the middle of that period and the company still has not paid taxes, but they have to make reserves or accumulate those taxes. So the company owes the government, let's say, 10 lakhs in taxes. Yeah. Now here we are beginning to see liabilities. These are what popularly are called, not popularly, they're only called liabilities. Okay, and even within liabilities you have the concept of current liabilities and non-current liabilities, and the difference for that is, now for example, and how do you decide what is a current liability and what's a non-current liability is that, for example, you take this loan, for example, even though your entire loan amount is 25 lakhs, you probably don't owe the entire 25 lakhs this quarter or this year, right? It's a 10-year loan. You probably owe only like maybe 1 lakh in this quarter. So what is a current liability is what part of this loan do you owe this period. That is a current liability. Maybe you owe a current liability. Okay, let's just say that, and let's just say loan, and maybe you owe only 1 lakh this financial period, and that's your current liability. Sorry, I put 10 lakhs. 1 lakh. That's your current liability. And this is what is called as a non-current liability. You owe this only much later and not immediately. Yeah. So let's just tabulate what your total liabilities are. Very simple. It is the sum of your current and your non-current liabilities. Now, similarly, then your company, the small company has assets, it has liabilities. So what is the company finally worth? It's not very different from how we calculated what you're worth. What this company is, excuse me while I just format this. So this company, that is the net worth of this company, is nothing but its total assets minus its total liabilities. 1.6 crores. Yeah, the total assets here, totally it's 2 crores, all those things put together. Liabilities are about 36 lakhs. So 2 crores and 5 lakhs minus 36 lakhs is 1 crore and 69 lakhs. That is the total net worth of this company. This is otherwise also called shareholders equity, and the reason it's called shareholders equity is because that is what the shareholders own in a company after the assets are netted to the liabilities. It's also called shareholders liability. One other thing you should know here is you remember how in an income statement we said an income statement is always for a period of time. It's for a month, in this case October 2001, or it's for a year or for a day. A balance sheet is never for a period of time. A balance sheet is the status of company on a specific date, on a specific date. Now, for example, this company's balance sheet is going to be as of October 30th, 2011. What that essentially means is, for this company, as of October 30th, 2011, it had 50 lakhs of cash in the bank, 50 lakhs in stocks, 50 lakhs in fixed deposits, 2 crores in assets, 36 lakhs in liabilities, and 1.69 crores in net worth or shareholders equity. And it is as of a specific date. You know, you can't show a cash balance over a period of a month. Then you have to have different columns, but a balance sheet is always for the status of a company on a specific date of a year, and that's a balance sheet. So there you go, that's a balance sheet. So in summary, a balance sheet has to accompany an income statement to provide a holistic view of a company's financial status. There is one other statement called the cash flow statement, which kind of connects the balance sheet and income statement, which is probably the topic of the 2 sessions from now. But this is the balance sheet, so you know what it is all about, what are the components of a balance sheet, and how to build a basic balance sheet for any business. In our next session, we're going to take each of these components, the current assets, non-current assets, liabilities, non-current liabilities. We are going to look at a real balance sheet of Domino's Pizza right here and try to understand how it is different from what we just laid out here in a simple balance sheet. Thank you very much. I'll see you soon at the next session.